Okay, our next presentation is from Unilever. It's great to have Unilever with us once again and to welcome back Andrew Stephen, Head of Investor Relations, and also with us in the room is Becky Pierce from IR. There's lots to discuss in relation to category, geographic, innovation trends, and that we're seeing within the Unilever group, not to mention the implementation that we're also seeing of new functional models, further cost-saving and efficiency initiatives. And that's before we even perhaps start to talk about the recent acquisitions the group's engaged in with Dollar Shave Club and perhaps strategic discussions around perhaps the future of spreads, etc. So without further ado, I'm going to leave Andrew to add all the value and hand the floor over to you, sir.
Thanks, Simon. So good morning, everybody. And I can genuinely say that it's always a pleasure to be back in the US, and particularly at this conference, which I've been coming to for many years, and particularly here in Boston. And just taking a little walk around the town out of the hotel yesterday, I was forcefully reminded, going past the Boston Tea Party exhibition, that of course Boston is rightly proud to call itself the birthplace of American independence. And with perhaps more than a whiff of nationalism in the air on both sides of the Atlantic at the moment, and even around the globe generally, I just thought I'd start with a short cautionary on language. If you do bear in mind, I will be giving my presentation in UK English today, not American English. So if you hear me talk about ZBB, I can assure you that does translate into ZBB in American, and it is the same process as you would know, but the way we apply it in Unilever might be very different to the way it would translate, for example, into Brazilian Portuguese, say. So I'll come back to that a little bit later in the presentation. I'll also touch on the question of nationalism, not nationalism per se, but more generally fragmentation and the balance of global and local. And so with that, let's get going. And of course, the first chart is the standard safe harbor statement. But today, I really want to focus on three areas that I know are of interest. How we're developing our portfolio of brands and the role of both innovation and M&A within that. How we see emerging markets and their contribution to future value creation. And our approach to continuous improvement in our cost base to drive profitable growth, particularly with zero-based budgeting. But first, here's a reminder of the strategy for long-term value creation at Unilever that we set out at this conference last year. And it starts with the four compass pillars that we've had in place for some time: winning through brands and innovation, winning in the marketplace, winning through continuous improvement, and winning through people. Each of these apply across the portfolio. The initiatives within them apply across the portfolio so that we can leverage the scale of our more than 50 billion euro business. And that scale gives us benefits in a number of ways. It helps us build deeper consumer insights with an understanding of the whole person, not just a specific category need. It gives us unrivaled distribution reach, particularly important in emerging markets. It helps us roll out global programs like net revenue management, for example, and it means we can recruit and retain some of the best talent in the industry. Now, those four compass pillars are translated into four specific and differentiated category strategies, each with their own priorities. And it's all underpinned by the Unilever Sustainable Living Plan. And that's important to stress that isn't just an extra slide in the chart. It's not a nice-to-have add-on. It's actually an integral part of each element of our business strategy, securing long-term value creation. We see the benefits of that in more growth, less cost through less waste, less risk, and more trust. Now, the objective of this strategy overall is to create shareholder value through what we call 4G growth. That's growth which is consistent, competitive, profitable, and responsible. I think our first half-year results demonstrated continued progress against this strategy. In what does remain a challenging trading environment, growth was consistent at 4.7%. With a tougher comparator to come in the third quarter, we expect underlying sales growth to be around the middle of our 3 to 5% target range for the year as a whole. Growth was competitive. In fact, all 4 categories grew ahead of their markets. And it was profitable. Core operating margin was up by 50 basis points to 15%, and that includes an 80 basis points improvement in our gross margin. And it was responsible growth. The Sustainable Living brand does cover all our business, but within this we have a subset of brands for which we've set specific standards for the extent of their positive social impact and products with reduced environmental footprints. We call those Sustainable Living brands. Now, they grew a percentage point faster than the rest of our business. The detail of the results also demonstrated continued delivery against the strategic priorities that we set out for each of the 4 categories that I talked about earlier. In personal care, we set the goal of building in premium. And in the first half year, our overall personal care business grew 5.7%, but within that, our premium brands, that's those with a price index more than 20% above the average in the market, grew faster than the rest at 8.4%. In foods, the priority was to improve growth. This picked up to 2.3% for the first half year. Now, that number includes 5 to 6% growth for savoury and dressings, partially offset by the decline in spreads. As you know, we're managing spreads now in a separate unit within foods, and we're focused on preserving the value of the strong cash flows that business generates. In home care, we set a medium-term objective of achieving double-digit margins. We're now very close to that at 9.8%, well ahead of time, and we don't intend to stop there. In refreshment, we focused on improving our return on invested capital, particularly in ice cream. And this is now a much more attractive 15%, up 300 basis points over the last few years. Now that brings us to the 3 key topics for today. How we're adapting our portfolio, the first of the 3 key topics, how we're adapting our portfolio, both organically and through M&A, to remain relevant in a changing world. We start from a strong position, which is well illustrated, I think, in the latest Kantar World Panel report. So this is an independent research that we picked up. This analysis covered 1 billion households across 44 countries around the world. They looked at 300 billion shopper decisions, 300 billion, to see how many times a brand was chosen by consumers over the course of a year. What it found was Unilever's market share of the top 50 global FMCG brands is actually 24%, well ahead of the next nearest competitor at 14%. And our portfolio includes 6 out of the top 10 so-called recruiters. That's the brands, that shows the number of new households that are reached each year. So last year, for example, Dove reached 31 million new households and Sunsilk 25 million new households. So while local competitors are gaining share in our markets, there's no doubt about that, our own shares are also up. So not only are our brands still apparently very relevant, they also seem to be getting stronger. Our portfolio, and indeed our business model, has developed over many years around maximizing the benefits of both global scale and local relevance. At the simplest level, global brands make up around 90% of our total sales, and local brands, only present in a single country, would make up the other 10%. But the reality of how we innovate and activate our brands is much richer than that. Another way of looking at it is that around 70% of our activity is on innovations and brand communication, which basically shares the same look and feel around the world. Here we maximize our advantages of scale. But even for these, we're actually now bringing more of a local flavor than we have done in the past. I'd like to show you an example of advertising by Dove that illustrates this. You probably know Dove's shared brand purpose around the world is to help raise women's self-esteem. What you're about to see is a uniquely Indian expression of this. So if we could see the advertising, please.
Isn't it strange that in a country of 631 million women, there is still only one face of beauty, when there is so much more to be admired? break the rules of beauty.
It's important to stress that while some of our global brands, like Dove, are seen as international brands, they are international brands, they're seen that way, others are actually considered to be indigenous in each country. So Omo, our largest global laundry brand, is thought to be a Brazilian brand in Brazil, while in Turkey it's sort of being Turkish. So that's the sort of 70% of our business and activity that's around global brands and scale, that left-hand box. The middle box, which is around a further 20% of our show of our activity, is behind global brand propositions and technology platforms, but with specific products adapted to meet local needs and trends. It's like Knorr cooking ingredients designed for local cuisines, or Sunsilk shampoos that meet particular needs, let's say, of Muslim women wearing a hijab, or Filipinos who spend much of their day on motorbikes wearing helmets. And the remaining 10% of activity is on the truly local brands, like Bango in Indonesia, Lakme in India, Marmite in the UK, and so on. And the changes we're making now to our organization under the Connected for Growth program will help us to continue to maximize the benefits of scale on the truly global 70%, while making us more agile and responsive to local trends on the 20% and the 10%, the two right-hand boxes. More and more of our global innovations include differentiated technology that brings consumer benefits that allow us to charge a premium and increase margin. No news there. Around 45% of our innovations now incorporate new technologies that we've developed, up from about 30% a few years ago. In ice cream, for example, this could be our double-dipping technology for Magnum, or ice-structured proteins that help us deliver a high-quality product despite the temperature changes in an extended supply chain in emerging markets. And we continue to speed up the innovation process. So, for example, the new range of Rexona antibacterial deodorants was launched into 37 markets in just the first 6 months of this year. Now in 40, I think. We're looking to reduce the rollout times for our global innovations by up to 30%, another 30% on top of the speed up that we've already done. Meanwhile, the Connected for Growth changes should enable us to reduce the time to launch some of our local innovations by 50%. The final aspect of innovation that I want to cover today is how we're addressing some of the high growth segments. This can be with either global or local initiatives. You'll, of course, have heard many people talk about the trend towards naturals. Now, it's actually quite complicated. There are many facets to what is naturals. One segment is what you might call inspired by nature. So in our case, that would be an example like Tresemme Botanique that we've just launched. We've launched that in 3 of our top 4 markets. Or from Radox, the Charged by Nature shower gels. In foods and refreshment, it's different. It's more about the authentic origin of the ingredients themselves, like with our natural meal makers range from Knorr that you can see on the chart. Or Pure Leaf Teas, which is a very successful brand in ready-to-drink tea that we developed in our Pepsi-Lipton joint venture, which we're now starting to introduce as a brand into hot tea in our mainstream business, just in the next few months. Another segment is free from, so like new, the non-dairy from Ben & Jerry's, or Lux silicone-free shampoos, or anti-allergenic brands under the Neutral brand. We also see in India rapid growth of Ayurvedic products with their roots in traditional Indian herbal medicine. We've launched an Ayurvedic variant of Fair and Lovely. We're reintroducing an old brand that we used to have called Ayush, and we've acquired an Ayurvedic hair oil brand, Indulekha. And that illustrates, I think, a point that M&A can complement innovation in developing the portfolio. In fact, over the last 8 years, we've disposed of some 3 billion euros of turnover, mainly in lower growth developed markets foods businesses, and we've achieved good prices in doing that, an average of 1.9 times sales, which exceeds our retention values even after taking into account the often substantial tax bill incurred. But over the same period, we've acquired 3.8 billion euros of turnover, mainly in higher growth personal care brands, some refreshment as well, at an average multiple of 2.3 times. As a result, the shape of our portfolio has changed. Personal care has increased from 28% in 2008 to 38% today, now our largest category, while foods is down from 35% to 24%. And it's now more focused on the more attractive segments. At the same time as innovating and continuing to strengthen the core of our business, we're also creating separate, more flexible models around the edges. These allow us to do a number of things which would be difficult to do within the core. They let us operate in a more entrepreneurial way and in new segments where the value chain is different. They help in developing new channels, and they allow us to build new capabilities more quickly than we can otherwise do. They're typically higher growth businesses with attractive intrinsic profitability. Each category has its flexible business models. In fact, Food Solutions and the Lipton Pepsi joint venture for ready-to-drink tea were forerunners. Both are growing ahead of the Unilever average. Ben & Jerry's is another long-standing example. And following the acquisitions of T2 and Grom, we're now building more refreshment brands through a retail-led model. In home care, we run the purifiers business separately from the core. We have 2 brands in water purification, Purit and Chinwan, and last month we announced the acquisition of Blue Air in air purification, bringing synergies in R&D, marketing and sales with the water purifiers. Combined sales of the 3 brands are now around 400 million euros. Within personal care, we've set up a separate unit to manage the prestige brands, also around 400 million of sales, and with an aim of taking this to 1 billion. And it's this flexible business model approach which we'll use to keep driving growth for the Dollar Shave Club acquisition, which we completed last month. This move takes us further into the male grooming category, a 40 billion euro market, growing faster than the personal care average, so a huge opportunity. The acquisition brings a brand, portfolio, and dialogue with consumers that extends from razors into hairstyling, skin care, and skin cleansing. It nicely complements our existing core male grooming brands like Dove Men Plus Care and Axe. It's also the category leader in the direct-to-consumer channel with a very attractive and successful subscription model. The model involves upfront investment, of course, in acquiring subscribers during the rapid growth phase, which the business is in now. Thereafter, it is inherently profitable with a very loyal base of consumers regularly buying a range of products across value, mid-tier, and premium price points. All of these flexible business models are attractive in their own right, and by incubating them separately within the categories, we're building capabilities that we expect to deploy elsewhere in the future. But I would stress that while the additional benefits of the learnings we gain from the acquisitions only become apparent over time, we have not had to compromise on our normal financial criteria in making the acquisitions. So now let me turn to the second theme, emerging markets. Emerging markets have been, are, and will continue to be fundamental to Unilever's growth and value creation. In fact, over the last 25 years, as far back as we could look, our emerging market businesses have grown on average 9% a year organically, with 5% from volume and mix, and 4% from price. And while this growth is inherently more volatile, volumes in aggregate have grown in emerging markets in every single one of those 25 years. Even in the current slowdown, our emerging market business is growing by 7.1% in 2015, including 2.7% from volume, and by 8% in the first half of this year, with nearly 3% of this from volume. We're actually unique in now having 70% of our volume, which is perhaps the best measure of scale of our operations, the number of cases that we sell, in emerging markets. Unit prices are a bit lower, of course, so emerging markets represent 58% of our turnover. Margins are slightly lower than those in developed markets by 1 or 2 percentage points, so emerging markets contribute 55% of our EBIT. Let me try to set out briefly how we're continuing to achieve this growth, even in the difficult market conditions, and why we see plenty of continued opportunity in the future. First, our portfolio positions us well to realize the opportunities for market development that we see, in fact, across all 4 categories. In total, today, we have a business of 30 billion euros in emerging markets. This includes 12 billion in personal care, growing at 7%, 8 billion in home care, growing at 6%, 5 billion in foods, growing at 7%, and 5 billion in refreshment, growing at 9%. So you can see growth across the categories. The swelling number of people at middle income levels, another 800 million people coming into those middle income bands expected by 2020, drives increased per capita consumption. For example, in deodorants in Asia, where the penetration across most markets is currently still less than 50%. Or in ice cream, where the per capita consumption in Southeast Asia is still a tiny fraction of the US. With greater urbanization, a really important trend, there will be another 400 million people living in cities. And that means, quite simply, more kitchens and more bathrooms for us to help get cleaned. We can expect 300 million more women to move into paid employment by 2020. That brings with it greater demand for products that offer more convenience in home care, new formats like liquids, and increased penetration of automatic washing machines, driving the need for machine specialist laundry products. And in foods, for cooking ingredients that save time in preparing the family meal, as well as higher demand for personal care products. Unilever, we think, is particularly well placed to realize these opportunities. We have deep roots and a strong cadre of local management. In fact, 80% of our country leadership teams, that's the leadership teams in the countries, 80% are locals. This helps bring consumer understanding, but it also means sensitivity to local market conditions. And this, combined with local P&L responsibility, helps us to manage effectively through periods of volatility and deliver consistency of performance. And we have a portfolio which is well suited to continually compound to build scale. Most of the global and local brands I talked about earlier have been built over generations. We have product ranges that span across price points and consumer needs. Taking laundry, for example, you can see on the chart the way consumption evolves with increasing income levels, from bars to powders to liquids and to products like fabric conditioners and stain removers. It's the same in cooking ingredients or in tea, with the evolution from loose leaf in bulk to bags to specialty teas, or in personal care, where we can build regimes like hair conditioning or styling. And the scale of our portfolio across our 4 categories of everyday products brings distribution strength. It allows us to reach, either directly or through our distributors, 8 million outlets, up from 4 million 6 years ago. In fact, it's because of this multi-category approach that we've been able to build in emerging markets the business that we have today. In many countries, we started with a spine of distribution in laundry and basic foods and used this reach to build in other categories. The same logic applies today as we use our distribution strength to extend personal care, move into liquid detergents, grow in cooking ingredients, or expand our ice cream sales. Our distribution reach in emerging markets, we think, is an enduring strength, but it's never static. So let me give you a couple of examples of how we're extending it further. Firstly, in small stores. In Southeast Asia, for example, 70% of our sales flow through distributors who are increasingly exclusive to us. This allows us to build digital capability into our distribution networks to sustain a competitive advantage or even increase it. Our lever edge system harnesses the power of data to make our distributors more effective extensions of our sales force. In Thailand, which was the first country to adopt the lever edge system, we've seen an additional 170 basis points of growth that we can attribute to it. We've extended it through the rest of Southeast Asia and are now introducing the system to our distributors in Africa. So far, we've deployed it across 15 markets, encompassing 1,300 salesmen, reaching nearly 2 million outlets. Our ambition over time is to cover at least half of our indirect sales in this way. At the same time as further strengthening our traditional distribution, we're of course extending our distribution into channels which are new for our categories, like e-commerce. To date, in emerging markets, e-commerce has only really taken off in China, where we already have 10% of our sales online, and the models are becoming pretty well established. Elsewhere, it's still very early days, with 1% or less of the market online. But you just have to look at India to see the variety of different models that are being tested, as the emergence of so-called marketplace retailers like Snapdeal, grocery online models like Big Basket and Grofers, and beauty.com players like Purple and Nykaa. And then there's our own Humara shop, a small pilot, but one that we've been developing that allows shoppers to make a purchase online and then with the order fulfilled by their local convenience store. So a lot happening, a very exciting area. Now let me turn to the final topic, the programs that we're driving to ensure continued profitable growth for many years to come. As you've heard us say many times, and I said again earlier, our model is one of 4G growth. That means growth that is consistent, competitive, profitable, and responsible. And fundamental to delivering against this model is continuous improvement in our efficiency and our cost base. This both fuels reinvestment in growth opportunities and underpins steady improvement in our margin. We've been making good progress. Over the last 3 years, gross margin has improved by 170 basis points, helped by positive mix change, and an ongoing supply chain improvement program that's delivering about €1 billion a year of savings. This program is well established and will continue at around this level for the next few years. Important to note that the savings here largely help to offset cost inflation, reducing the need for pricing so that we can make our products more competitive every year. In overheads, Project Half delivered the targeted €500 million savings, more than offsetting the effects of exchange rates and increased investment in capabilities. And in advertising, more efficient spend on production agency fees has saved around €200 million. This has been fully reinvested in increased digital advertising behind our brands and innovations. So all of this has underpinned continued growth ahead of our markets on the top line, but also an increase in core operating margin of just over 100 basis points over the 3 years. But of course, continuous improvement means continually raising the bar. And at our investor event at the end of last year, we set out 3 key programs to ensure we continue to deliver profitable growth in the years to come. And the first of these is net revenue management. In essence, this is a very detailed program to optimize pricing, including promotional spend, across individual SKUs and channels. The program targets both additional volume and additional price. This can be an extra 1% over time. It helps to secure growth ahead of markets despite competitive challenges, and of course it supports gross margin improvement. So far, the program's been rolled out to about a third of our turnover, and we expect to have covered some 50% by the end of the year. The second program is the organizational change, which we call Connected for Growth. It's designed to keep us one step ahead of a changing world, a world which is becoming at the same time both more global and more local. It'll make the organization faster, simpler, more consumer and customer-centric, and future-proof, we think, for the connected world. It'll help us unlock trapped capacity to do more with fewer people. We'll better leverage what can be done globally with scale, while at the same time dialing up in each country what's best done locally. The new organization will have fewer layers, and more of our resource will be deployed in strong global brand communities and local operations, and less in staff roles. There'll be fewer touch points. And finally, by redesigning our processes further, we aim to reduce the time spent on activities like managing the innovation funnel by up to 50%. This means more time spent with consumers and customers. In a nutshell, Connected for Growth will help us make us more agile with lower costs. And the third program is zero-based budgeting. I've been asked a number of times by investors last month, last couple of days as well, whether this is a good fit for Unilever, and the answer is absolutely yes. Our approach is an integral part of our 4G growth model, and this isn't just meant to be a play on words with 3G, but it is worth distinguishing where our approach and our philosophy might differ with theirs. This is a good example, I think, to take. First of all, it's fact-based. In the first half of this year, we focused on data gathering and comparisons with benchmarks, visibility, in other words. This has shown that overall, and in many individual areas like travel, for example, our spend is already below the median of our peers. In R&D and market research, we invest above the benchmarks, and will continue to do so because they're key to our growth model. So savings in these areas are likely to be minor, but there will be opportunities. And then there are areas where we see significant opportunities to improve. In consultancy, for example, or in the cost of repacking product for promotions, to name just two. The key point is that our approach is focused on value and growth. We won't cut to the bone in areas which drive growth. Where we do identify savings, we'll be making informed choices about where to redirect resources or whether to take the benefits to the bottom line. The program's being driven by experienced business leaders, challenging what we spend, where and why. It takes us from a solely vertical ownership and management of cost to a horizontal and vertical management, bringing in the constructive tension that creates. And we think it's just the right time for us for such a deep analysis and review, because after all, our industry is changing so fast, the old paradigms and assumptions about where to invest do need to be constantly challenged. Now, the work already done has confirmed to us that the ZBB program, together with the organizational changes of Connected for Growth, should deliver the expected savings of at least €1 billion in overheads and marketing by 2018. The savings will be realized across all four categories, but how we deploy these savings is and will be determined by the individual category strategies, which I referred to at the start. And they're in addition to the ongoing savings in the supply chain of around €1 billion per year. In aggregate, we expect the savings to underpin continued competitive top-line growth ahead of our markets and steady year-on-year margin improvement. It's worth remembering that unlike many other companies, we absorb the associated restructuring costs within our core operating margin. We don't back them out. These are typically around 100 basis points each year, but likely to be 20 basis points or so higher than that for this year and next. So while the savings programs could deliver a higher rate of margin improvement than we've made in the last few years, in practice we're likely to reinvest in restructuring, building capabilities, and ongoing competitiveness. To conclude, let me just finish with an overview of our financial performance over the last 3 years. And the reason for doing that is that I think it's indicative of the sort of consistent value creation over time that we aim to deliver, even in challenging markets like we've been seeing. So over that period, over the last 3 years, underlying sales growth has been ahead of our markets at 4%. Core operating margin has increased by between 30 and 40 basis points in each of the 3 years. We've generated a cumulative €12 billion of free cash flow. Core EPS has grown by 11% per year at constant exchange rates and by 6% per year at current exchange rates after the effect of the weaker emerging market currencies during this period. Return on invested capital has increased to 19%. That's including goodwill, so that's despite the impact of the additional goodwill from acquisitions. And dividends have increased by 7% per year. So as I say, I think all this gives a pretty good indication of the sort of consistent performance we expect to deliver over the longer term, perhaps with a little more here or there, depending on market conditions, maybe a bit more on core EPS if there's less drag from devaluation. But whatever the environment, we remain focused on our priorities, and no apologies, this is the same chart as we've been showing year after year. That's the idea. Our priorities are exactly the same. Volume-driven growth ahead of our markets, steady improvement in core operating margin, and strong free cash flow. So before we move to the breakout, Simon, if you're happy, we'll just take a couple of questions and then go to the breakout.
Hi, good morning.
Hi.
Andrew, have you seen any changes, meaningful changes of late with the dollar stabilizing in some of the emerging markets in terms of demand?
Yeah, so any changes in demand in emerging markets? At the moment, I think it's quite an unusual situation that we're in, where we've got very little volume growth in aggregate. So I showed that we're growing our volumes in 2 to 3%, but that's in the context of, in aggregate, big average, which is always dangerous to do, but in aggregate, the unusual situation of 0% volume growth, which we don't expect to be persist forever. But there's a real then polarization in terms of the price growth, which is driving the market growth that we see. We've got a lot of pricing in Latin America, of course, reflecting the devaluations and recovery of the cost increases from that. And unusually, we've got very, very little pricing in Asia. Okay, so that's kind of the situation we're living in. What do we see happening? Well, Latin America, particularly South Latin America, Brazil and Argentina, as we said with the half-year results, frankly, we expect that to get worse before it gets better. Yes, it's true that, and it's good news, that the Brazilian economic numbers seeming to be improved, but all that means is there's less GDP decline than there was, but we typically see a lag before that affects our demand for our products. What really drives demand, and by demand I mean volume, is when consumer incomes at least keep up with the level of cost increases that's pushing up the cost of living. And that hasn't happened yet, for example, in Latin America. So at some point, we think Latin America will turn, but for the moment, it's still on a downward trajectory. Meanwhile, Southeast Asia has been improving, albeit off a relatively muted base. So that was encouraging in the first half year. In India, we've continued to see mid-single-digit volume growth, but the thing with India is that pricing had really fallen away to nothing. And so in the first half year, there was virtually no pricing. I think over time, through the rest of the year, we may well see some pricing coming back into that market, and hopefully with a continued solid rate of volume growth. So that's just to pick up on a few. Maybe just one other. I've mentioned China, not a huge market for us, but China, really the key feature of the market, continues to be this rapid shift, more than in any other country, from the traditional, the modern trade, if you like, traditional bricks and mortar into online sales. And that's a bit disruptive for that market at the moment, particularly as there's frankly just less stock, less inventory needed in the online channels.
Maybe I could just have a quick one then. At the end there, when you were talking about the cost initiatives that you've got coming through, the Connecting for Growth, is it the CBB or ZBB initiatives? You said that the work you've done to date has underpinned that 1 billion of targeted savings over the next sort of few years. I'm just trying to get a sense for the data that you've gathered in relation to ZBB. I mean, how far through that data gathering process are you? Are you largely done with it, or is there a significant amount to come to further underpin and drive these unknown, perhaps further opportunities that you see from a cost-saving standpoint?
Yeah, good question. So with zero-based budgeting, we're very much covering overhead and marketing, to be clear, not the supply chain. So it's that part of our cost base, which itself is big. We've focused on 17 cost areas, and within that, particularly 14 key cost areas. And we've focused on 20 units in the business, corporate center being one of them, but clusters being the rest. And we've covered probably something like 80% or so of our overheads and marketing spend with that program. For that part of the business, we're fully through the visibility stage. We're already into the second stage of the process, quite well into the second stage of the process, which is locking the savings into our planning process. So targeting how much savings there. Are we going to come down towards benchmark? How much? If so, how much are we going to come down towards benchmark? And then building those into our plans. And now we're moving into the phase of starting to realize them.
Okay, if there's no more in the room, I think we'll move through to the breakout session. So if you could join me in thanking Andrew and Becky. Thank you ever so much, Steve.
Thanks.